The quote went something like this, and I'm paraphrasing it, that volatility is the price that you pay to stay in the stock market. Right? Volatility is the price that you pay to stay in the stock market. This is a very powerful statement. What it simply indicates is that as a stock market investor, especially as a long-term investor or a swing trader, you have to witness the lows in the market. There is just no other way. Hi everyone, hope you are doing well. So on today's video, I'm going to do something very interesting. So I'm going to talk to you about how did I build my wealth in the stock market and what are 3 key lessons that I have learned. I have learned a lot of lessons, but there are 3 very important lessons that I will share with you on this video. So let's get this video started. Just a very humble request that if you like the content that I shoot, please like and comment on this video. It would indicate to me that you would want me to continue making more videos on stock market, finance, investing, and I would continue to do that. So the first key lesson that I have learned as an investor in the stock market is that you must understand major economic trends. This is a highly underrated skill that majority of the retail investors do not focus on. They worry too much about how the individual stock is doing. Let us find some multi-baggers. Let us just go and buy and invest in penny stocks. While it is good to be stock specific, but more importantly, understanding major economic trends that is going to shape up your returns in the long term. Now, what do I mean by major economic trends? So first and foremost, it could be something like bull run. Now, this is a concept that I've explained extensively in one of my earlier videos. I'll link it somewhere here. Please go and watch it. It's a very useful video for you to understand about economic returns and how the economies shape up. Now, the power of identifying such bull runs or macroeconomic trends is very simple. So you might know that in the US, there was a major economic bull run from the year 2009, just after 2008 financial crisis, and it continued from 2009 to 2018. Now, during this period, the average return of the index was around 330%. So it tripled in that 10-year period, which is a massive return. If you look at the bull run that happened in Japan stock market, it existed from 1978 to 1991, and the stock market rose from 2000 base to 37,000, which was a massive return. Similarly, China saw a massive bull run from 2004 to 2009, where its stock market literally increased by 4 times its base value. So now this brings us to the interesting question that, hey, has some kind of a bull run happened in the stock market in India? The answer is yes and no, depending on how you define bull run. But to cut the long story short, that compared to Japan, compared to China, compared to the US, we have not had a similar type of a bull run in a market like India yet. Right? And I'm stressing on the word yet, that in India, compared to something like Japan, the bull run has not happened yet. What does that indicate? That indicates that in a country like India, where the GDP is generally trending upwards, where there is a lot of demographic dividend. Demographic dividend means that a large chunk of the population is working age, it's educated, and it's on the younger side. To top it off, there is a lot of investment coming in India and bunch of different positive things that are happening for the Indian market, which makes the bull run scenario in India inevitable. It's only a matter of when it will happen, not whether or not it will happen. It will definitely happen. We just have to wait and watch when that happens. There is a very high likelihood that there might be a massive bull run in the next 1 or 2 decades in India. And if you miss capitalizing on this major macroeconomic trend, you might actually regret 20 years down the line. So in summary, what I'm trying to say is very simple, that if you're a long-term investor, by long-term I mean that if you have 30, 40, 50 years of time horizon like me, then you must identify these major good pockets of time when you should be making investments, right? You must identify good times when to make investments. For example, according to me, that time to make investments in the Indian stock market is now, right? I am investing aggressively. I have been investing very aggressively since the 2020 crash, and I have made a lot of money. Again, I'll link the video somewhere here. You can check it out. So the first key sub lesson that I'm trying to tell you here is that you must identify good pockets of time to invest. That is point number 1. The second important lesson is that you must identify the right set of sectors in which you should be making investments. So yesterday I put out a video on the EV sector, which is the electric vehicle sector, and why according to me that sector will grow. So I showed a lot of research, a lot of analysis, and I'm quite bullish on that sector. And I told you which stocks you can consider potentially in terms of investing. So definitely go check it out. Again, I will link the video somewhere here. So do give it a go. The point that I'm trying to tell you is that in a growing market, generally, the entire market will develop, no doubt about that, but certain sectors will outperform the others. Let me give you another example. Now, when the bull run happened from 2009 to 2018 in the US, FANG stocks, FANG, and I'm not even including Apple in it. So FANG stocks, Facebook, Amazon, Netflix, Google, they added $2 trillion to the stock market, which was a massive, massive return. There was a major bull run that happened in the technology stocks. Similarly, if you look at the March to June 2020 data, you will realize there was a massive run up on FMCG stocks. Then subsequently, pharma stocks had a very strong performing cycles. So if you can invest in these growth sectors in the short term, it can give you a lot of more capital that you can then rotate and put it in your long-term portfolio. So the point that I'm trying to drive home here is very simple, that there are certain sectors in the economy that will perform really, really well in a given period of time. So you must be good at identifying those sectors and make sectoral investments also. Now third, you must understand the difference between aggressive and defensive stock. This is a concept that I have spoken about earlier, but this is a good refresher. That for example, so let me quickly help you analyze HUL, right? Hindustan Unilever. So if you take a look at this stock and if you analyze the data for the last 5 years, this is the trend that you will see, right? So you can take a look that in March. Now this is where the coronavirus happened, approximately late February, early March, and the stock tanked to 1900 levels from 2200 levels or 2300 levels. Not a massive drop compared to, if you compare it to finance stocks like Bajaj Finance, or if you compare it to HDFC Bank, or if you compare it to any other sector like automobile, energy, infrastructure. If you look at stocks like Dabur, HUL, Nestle, they did not fall much. Okay, that's one. Second, take a look at how soon they recovered. They literally recovered by 15th April and created a new high, right? So here it's creating a new high of 2500. Right? These stocks are called as defensive stocks. So there are certain stocks like ITC, HUL, Nestle, Dabur. These are called as defensive stocks because irrespective of the economy, you will continue to spend money on these basic commodity like goods. For example, you will not stop using soap. You will not stop using shampoo. You will continue to eat rice, right? So these are commodity retail oriented goods, and the companies that actually are into manufacturing these type of goods are called as defensive stocks, right? So even if the market is following very much, these stocks are not going to fall much, right? And when the market actually goes up, these stocks are not going to go up. Why am I saying it? So for example, take a look at where we are trading now, right? Back in March, the Nifty was somewhere around 8,300 levels, right? 8,300 levels. But how did HUL perform? So it fell, the Nifty fell from 12,000 to 8,200, 300 levels. There was a 40% dip, 40-45% dip in the stock market, Nifty overall. But HUL barely went down, right? It went down by like 10-15% and it came up very, very quickly. So these are defensive stocks. But now the Nifty is trading at an all-time high, 15,860 as I'm shooting this video on June 25th. And where is HUL trading, right? It's actually trading below its April high of last year. So this is the nature of defensive stocks. You must understand that, hey, if you are making investments in a growing economy, then you must pick aggressive stocks to make a lot of returns. But on the flip side, it is okay to pick and diversify your portfolio. You can invest in defensive stocks. But if you are picking defensive stocks, you must understand that, hey, you know what, this stock portfolio is not going to go very, very high. Stocks like ITC, stocks like HUL are not going to create massive amount of returns for their investors in an aggressively growing market, right? So this is a very important concept to understand. On the flip side, very quickly covering what aggressive stocks are. So aggressive stocks would look something like Bajaj Finance, right? So let me show it to you. So Bajaj Finance, right? So this is a finance stock and majority of the finance stocks are called as aggressive stocks. So again, if you take a look at the March data or the coronavirus peak data, it was trading at 4,800 levels before the coronavirus pandemic. It went down to 2,100, right? So there was a more than 55-60% fall on this stock. Now, where is it trading now? It actually has made a new high. In fact, it is above 20% of its peak level before coronavirus. So these are aggressive stocks that they move very, very fast in both directions. When the market is falling, these stocks will come down crashing, and when the market is going up, they will zoom like anything, right? So three very sub-important concepts I have covered. Invest at the right time. Identify when the bull run is going to happen. If you can identify it, great. Invest. Pour in a lot of money. Completely okay. Number two, identify growing sectors. For example, I'm betting quite heavily on electric vehicles. I'm betting quite heavily on finance sector. I'm betting quite heavily on small finance banks in India. So the reason why I'm doing that is very, very simple, because I consider that, hey, a bull run is going to happen at India in some time in the next 2 decades. And these aggressive set of stocks are going to actually create massive returns. The second key tip that I have for you in the stock market is that you must understand the advice of big investors but truly analyze that advice. Nowadays, there is a lot of chatter that, you know what, Akshat, the stock market has gone up and it has created new high and it will come down, right? Because coronavirus problem is there. It's a bubble. It will burst at some point and then I'll buy the stocks. Now, Ray Dalio has given a major framework in terms of analyzing whether a market or a particular stock is in a bubble or not, right? So this is a framework that is out, but majority of the retail investors do not analyze this stuff. They just simply go ask for stock tips, which is not right. You must do your analysis. For example, let me walk you through Ray Dalio's framework and let us try to understand whether the current market is actually in a bubble or not, right? So he has given 6 specific concepts and I will put this chart on your screen as well as I am reading through this. So the first concept is that you must check whether the prices are high relative to traditional measures. So what does this mean? This simply means that, for example, let's say that 5 years ago, you used to go and buy a house in Gurgaon, right? Its price was 2 crores. Now, what is the price today? Now, if it suddenly becomes 10 crores, there is a sudden spike, right? So you must analyze such a situation that why has the prices increased so much? And if there is no rational analysis to that the other asset classes, for example, if you're trying to buy a house in Noida or if you're trying to buy a house in Faridabad and if the prices haven't gone up that level, probably Gurgaon housing market is in a bubble, right? So that is what the simple definition or understanding of the prices are high relative to traditional measures would mean, right? Now you tell me, is the current stock market in a bubble or not? What is the measure that you would look at? The measure is called as PE ratio. The PE ratio of Nifty. So let us try to look at that. So here is the entire data of Nifty 50 PE ratio, right? For example, if you go take a look at 2017 data, January, the PE ratio was 22.44. Okay. If you take a look at March data of PE ratio, it was at 40.43. If you take a look at the PE ratio today in May of 2021, it is 29.27. It is not high, right? 29.27 PE ratio is not high, and therefore I feel that the first criteria that, hey, is the stock market overvalued right now? No, it is not. It is a liquidity driven rally, right? I have talked about inflation in the past. Please watch that video. That will give you more understanding. But to cut the long story short, currently where we stand, the PE ratio indicates that the overall market is not in a bubble right now. The earnings of a company are matching the prices at which it is trading. Therefore, the PE ratio is somewhat balanced. It's under 30. Now, the second criteria that Mr. Ray Dalio suggested is something called as prices are discounting unsustainable conditions, right? What does this mean? For example, if due to coronavirus, the entire economy came to a halt, hypothetically speaking, that trucks are not moving, shops are not opening, massive losses to companies, people getting fired, all that, right? And that situation is not salvageable, okay? So back in 2020, did this happen? Yes, it happened. Did the stock market fall? Yes, it fell. The second wave of coronavirus, recently, it's still ongoing, but it recently happened and it reached its peak, right? Were the shops closed for a massive amount of time compared to last year? Answer is no. Did people lose their jobs compared to last year? The answer is no. Did other bad things happen that the government imposed massive lockdowns for like months? Nothing of that sort, right? So the economy is still moving. I'm not saying that everything is hunky-dory, but the point is that the impact of coronavirus now, it was not as massive as it was, or the panic is not that high as it was back in 2020. Right? So these are not unsustainable conditions in Ray Dalio's framework. Third thing, new buyers have entered the market. Okay, fine. A lot of new retail investors have entered the market, no doubt about that. But they have been entering the market since 2020, and honestly, the amount of total money that retail investors put in the Indian stock exchange, it's very less compared to FIIs and DIIs. Okay, so this is somewhat a debatable point. Number 4, there is a broad bullish sentiment. Okay, so for this, there is a good indicator on Tickertape. It is called as market mood indicator. So you can actually go to Tickertape and find out this MMI. It indicates that how much greed is there in the market right now, that hey, is everyone bullish? No. So currently, if you actually look at the data of this MMI and if you have been tracking it for the last 1 month or so, it has fluctuated between greed and extreme greed, right? And even the extreme greed needle is not very, very high, right? So it is somewhat frothy, right? That's what we would say, right? And that is what Ray Dalio has also been saying. The 5th criteria that Ray Dalio speaks about is the purchases are being financed by high leverage, which simply means that companies are taking on more debt. They are not actually selling more stuff, but they are taking more and more debt. That is not the case, right? If you analyze the balance sheet, it has improved from the 2020 scenario. In 2021, companies are actually having healthier balance sheets. That is the reason why PE ratios have come down. okay, because the earnings have improved, right? In the PE ratio, P is the numerator, earnings is the denominator. So let me explain this concept slightly more deeply, right? So PE ratio means that price to earnings, right? So earnings means that how much is the company earning, right? So this has actually went up in the last 1 year for majority of the companies, in generally speaking, right? And the price has not risen at a similar rate. Therefore, the PE ratio that I showed you earlier for the market has come down, right? This is a very important point to note. Now, the sixth criteria, let me quickly go through it. It simply means that buyers and businesses have made extended forward purchases, right? So it simply means that, for example, are they stocking stuff? For example, are they engaging extensively in the cash segment of the stock market versus the futures and option segment? No major data has revealed that such a scenario is there, right? So honestly, like if we analyze all the factors, some factors are negative, majority of the factors are positive. Therefore, like Ray Dalio, I am of the view that the stock market is not in a bubble right now. It is completely okay to invest money in the stock market. So in summary, please do not just simply quote people like Warren Buffett, Ray Dalio, Charlie Munger, etc. Analyze their work, right? You must pick up the frameworks that they are giving and analyze and contextualize it to the market in which you are making investments. People just generally say that, hey, make investments in the long term because Mr. Warren Buffett has said it. You can only make money in the stock market if you actually sell your positions, right? So Mr. Warren Buffett also sells his stock. It's not as if that he's holding those stocks for eternity. So please don't just simply quote people out of context. Analyze their work, contextualize it and implement it. This is what will make you a good investor. Now the third key thing, and this is probably the most important lesson that I have learned by investing in stock markets, is that you need to stay put, right? This goes against what I was saying a few seconds earlier, but I'll explain you the definition of what I mean by staying put, right? Or what is investing in a slightly longer horizon means, right? It simply means that, hey, there will be these economic cycles where the stock market will generally go up, right? For example, from the 2009 period to 2018 period, the stock market in the US was on a major bull run, right? It was generally going up. But having said this, there were days and there were bad events that brought the stock market down significantly also during this uptrend. For example, in August 2011, the US credit ratings dropped to AA+ and the stock market fell. It was one of the worst days for the US stock markets. In 2015 and 16 period, China devalued its currency. Again, during this entire period, the stock market generally went down. In 2016, there was Brexit issue, there was Turkey issue, the oil prices crumbled. Now, why am I stating all these negative events? Because sometimes we make decisions based on news. We will assume that, you know what, some negative news has come out. Let's sell everything and move out. It doesn't work that way. If you're making an investment for 10-year, 15, 20-year horizon, then there will be periods of news which you will not like. There is not one single instance in the history where the market has gone up like a straight line. It will never ever happen. Now let me show this in the context of the Indian stock market in the last 1 year. The last 1 year, the stock market has given massive returns. But again, there has been a major dip here, right? So there has been a lot of dips in the stock market, even on this general uptrend when the market has given 54.15 return in the last 1 year. So the point that I'm trying to drive home is that the markets will never move in a straight line. They will move in a very zigzag fashion. So there was a beautiful quote on this book, which is called as The Psychology of Money. And the quote went something like this, and I'm paraphrasing it, that volatility is the price that you pay to stay in the stock market. Right? Volatility is the price that you pay to stay in the stock market. This is a very powerful statement. What it simply indicates is that as a stock market investor, especially as a long-term investor or a swing trader, you have to witness the lows in the market. There is just no other way. So just to quickly summarize this video, 3 key lessons. Number 1, please understand the major economic trends and make your arguments. Be it investing in different sectors or growth sectors, do it. Be it investing in defensive versus aggressive stocks, do it. Figure out what is happening in the macroeconomy. Number 2, simply don't quote people like Warren Buffett, Ray Dalio, etc. In fact, pick up their work, read it, analyze it, and implement it. That is more important, because people just generally pick up statements that they understand from these people and apply broadly onto everything. That, hey, you know what, Mr. Warren Buffett said that he invest for the long term. Yes, he has said it, but that does not mean that never sell your shares, right? That is completely incorrect. Third and finally, please understand that volatility will be there in the stock market. If you fundamentally believe in stocks, And if you fundamentally believe in certain sectors, you have to stay put, even when the share prices are falling by 30, 40, 50%, right? There have been shares that I have bought which went down 40, 50% also, but they came up and gave like 200% returns. So it always happens in the stock market. So I hope that you enjoyed this video. Please give it a thumbs up. It would indicate to me that you value this content and you would want me to make these type of videos. Thank you so much, and I will see you tomorrow.